Bonds seem to love this. Gold seems to love it. Is Jay Powell being that dovish today?
He's a little bit. He's not really saying much of anything, to be honest with you.
Right.
The market is kind of thinking that nothing is going to happen in the immediate. And that's code word for there's going to be no rate hike.
Right.
There might not be a rate cut. There's going to be no rate hike. Largely because we're still struggling with the big Fed word is reaction function.
Okay.
What is the set of circumstances that would cause the Fed to raise rates?
Okay.
They've already said, we want to see inflation get up. We wouldn't mind if it runs a little hotter. Okay, you're not raising rates.
Yeah.
If the stock market goes up, you're not going to raise rates. So that's, I think, where the positive is coming from. It's a default positive. There's going to be no rate hike.
So what I'm trying to figure out is markets are supposed to be kind of relative in a sense where even if he's not hiking, he's not cutting anymore. So what in your mind is the easiest explanation for why every time he talks, this is now the second FOMC in a row, where you're getting this huge like dovish bid in bonds and gold in response. I mean, gold's up 1% now. And last time they tanked, the next, literally 2 days later, it's like people just can't give it up. Like the punch bowl is still there. It's gone for now, isn't it?
Right. No, they hope that the punch bowl is still there. I think part of the reason the market rallies is, let's go back a year ago. A year ago when he was speaking and said, the balance sheet's going to be like watching paint dry. The Dow fell 600 points while he was talking.
Right.
Over the summer, it fell 400 points while he was talking. I think it rallies just because, hey, he made it through without sticking his foot in his mouth.
Okay.
And so there's somewhat of a reaction there as well, too. But he's not.
And you're talking stocks there, because bonds and gold seem like they're sniffing out something. Is it the repo stuff? Is it QE? What are they so obsessed with? What are they holding on to? The gold bugs, and I call them the bond bugs now too, because there's a lot of events now I see adding up where you hear stuff that doesn't line up with the old dovish Fed,
right?
And they're still just piling in.
Right. I think that the bond market, keep in mind, is driven more by global growth than it is by U.S. growth.
Okay.
Global growth is weak. Most interest rates in the rest of Europe are negative. Mm-hmm. So that is putting a tremendous downward pull on our interest rates. It's going to be a while before we see substantially higher rates without Europe's rates start coming up. We would need to see the European, the Japanese, the Chinese data get better, pulling their rates up, which would allow our rates to go up. There's only so far we can go with the spread between us and Europe or us and Japan before we hit that limit. We've always been close to it. So global growth matters more than U.S. growth when it comes to bonds.
And this is what's so interesting, because I thought the global growth is the one that's been showing signs of bottoming out. We've seen the PMIs that look like they're leveling. We've seen some of the geopolitical resolution potentially start to form. So is that the shoe that needs to drop? To see the Brexit actually, get a vote and happen, to see the U.S. and China come to a resolution, because the manufacturing data is looking better, right? I mean, the German Bund yield's starting to creep up. In fact, it's creeping up quicker than the 10-year is, from what I can see.
Yeah, it is. Right? I remember the 10-year was at 145 in September. It's 1.45. It's 1.8 now. So it's been creeping up too. We had an amazing headline the other day that Japanese yields rose to zero. Let that one sink in for a minute. As well, too, for the first time since March.
But that's a big threshold.
Yeah.
The fact that we're finally getting out, because a lot of people 3 months ago, we're saying negative rates are the new norm. We're only going up from here. That was like the top for negative rates.
Right. But we still have $10 trillion worth of negative rates. We used to have 17. So there's still a lot of negative rates as well, too. But those rates are moving up. You're right that there might be signs of the global economy bottoming. And that's why we've gotten 30 or 40 basis points. But I'm saying you want another 40 or 50 basis points of rate hike, you would need a serious sign that the world is getting better. You've only got a sign that it's stopped getting worse, and that's pulled rates up. Okay. That remains to be seen whether that is the next leg in the global recovery to come. There's some data that suggests it can be the case. There's some data that doesn't. It's a bit mixed.
Yeah, and our ISM manufacturing still is a little bit of a laggard now. Ironically, we were the best house story. Right. Now you see some softness creep into the dollar. To me, that still remains possibly the big tell here for if that transition happens of rest of world bottoming and some favoritism possibly moving abroad. Can we trust the dollar and its move lower as maybe giving us the sign?
I've been very distrustful of the dollar because as we've gone to negative rates over the last year, the knee-jerk reaction should have been, well, if the U.S. is positive, everybody's going negative, there should be this giant pile into the U.S. and this massive move up in the dollar. There wasn't.
Okay.
And so there was a minor move, but nothing what you would have expected. So I don't know what's really the motivation on the dollar. My fear is with the dollar, when I talk to foreign investors, within 15 seconds, the conversation has to turn to politics and Trump's personality and a lot of things that I would like to say are non-economic that seem to cloud their judgment about the dollar. I think they need to get away from that and go back to pure economics to be driving it, but they're not. And I think that that's what's causing this kind of confusion with the movements in the dollar, at least in my mind.
One of the risks I see in the short term that is we have a president who we know he wants low dollar, he wants low rates, he wants high stocks,
he wants negative
economy.
rates. He's even said that too.
So we get evidence today, he's not getting that here.
Right.
How big of a deal is that?
It's not a big deal for him now because what he's getting instead is his 3 tweets a day that the U.S. stock market's making new highs and everything's great. So it isn't as, but if we were to see some kind of a correction in the U.S. stocks over the next several months, especially getting towards the election season, I think his calls will sound a lot like last summer, demanding that the Fed start cutting rates a lot more.
Right, and this is where you guys work with Ben Breitholtz from Data Arbor that we talk with a lot too, and he has the Trumpian Uncertainty Index where it got pretty quiet, and it's been starting to pick up a little bit again. Last in December 2nd, the president tweeted twice about lower rates, and maybe then if he sees, hey, I'm not getting my lower rates, maybe I need to execute a trade deal, that could be a very good thing, but at the same time, I worry about what happens if the trade situation escalates or doesn't slow, but the Fed can't cut right now because what we're seeing is a potential bottoming of manufacturing without a trade deal. So is there a risk here that the Fed gets put in a corner?
Sure. I mean, the big date that everybody's looking at is Sunday, the 15th. Will the Trump administration hike tariffs like they are scheduled to be hiked? The consensus is no, they're not going to do it. Now, we'll see. Larry Kudlow came out yesterday and said all options are on the table.
Right.
So we'll see what happens on Sunday. There is some market commentators suggesting if they hike the tariffs on Sunday, we could see a 10% correction in stocks before the end of the year. 2 weeks, 10% down, kind of look like last year. That could force the Fed if you see something along those lines. But first, that's got to happen. But the next major, well, we've got Brexit tomorrow, or excuse me, the UK vote tomorrow, which will have impacts on Brexit. And then Sunday, we'll have to see what happens when it comes to these tariffs. No one expects them to get hiked, or I should say that's the consensus, but we'll see what happens with it.
You're all over the repo stuff. We got to talk about it because as Jay Powell was speaking on repo, that's actually when gold really started to take off this afternoon. Let's say we get Brexit certainty. Let's say we get a China situation. Are those going to be good enough developments to where we can forget about this repo stuff, or is that going to be a risk detached from all our other macro conversations? Is the plumbing in as much trouble as some are saying that it is, given how long this has been going on now?
I think it is. I don't think we've solved the plumbing problem. My take of what Jay Powell said in explaining the repo problem is 3 months into it, we still don't know what's caused the problem. We are still trying to figure it out. And that is worrisome. What the Fed has done, as I've liked to say, is they've medicated the market. It's quiet and it's in the corner because they've pumped it full of reserves or drugs. That's okay for a while. That is not a permanent fix. I would like to know what the Fed's permanent fix is going to be, and they don't have one right now, and that can be a problem as we move into 2020. Look, at any point, they could come up with a fix. I think the real fix is, and he opened the door to this a little bit more, the real fix is they overregulated the repo market and they've constricted it.
Okay.
He used to say at the last press conference, we're not going to change regulations.
Right.
Today he said, we'll look at them. Okay. They've opened the door a little bit to that. But if they were to back off on those regulations to allow the banks to let repo money flow, their cash reserves flow to hand out those loans, this is a critical part of the plumbing. Most of your traders might trade on a margin account. How do you pay for your margin account? You deposit treasury bills. You don't deposit cash. Why? Because we have a functioning repo market that you could take treasury securities and turn them into money. So they're just as good as money. If we have a problem with the repo market, your treasury securities are no longer money. That can be very, very troublesome for all of us. It's not a problem now, but we got to get on with a permanent fix, not just saying we're going to get through the end of the year by supplying a lot of repo.
Help me out as a guy who doesn't, or anybody who doesn't understand it as well as you do, because I look at things here that might be totally unrelated correlation or some degree of causation given the role of treasuries and reserves that we're discussing. The chart for the 10-year treasury future year to date, this repo thing blew up 2 days after the September bottom in the 10-year future price after a sell-off that was almost unprecedented in the treasury market, that took us down to that went all the way from a yield of, where were we, 1.4 something, and then we went all the way up to 1.9 over the course of 2 weeks, and then 2 days later this dries up. Is there a connection? I know this is much longer, way out.
Right.
Are they totally uncorrelated?
No, they're not. There's a connection. There's a definitely connection.
So then we should be scared as heck about a big bond sell-off.
Well, yes. Let me give you what the connection is. You're a professional bond trader. You just bought $1 billion worth of bonds. How do you pay for it? You don't write a check for $1 billion. You call up a repo desk and say, I got $1 billion of securities. I would like you to take them as collateral, to give me $1 billion loan to pay for my securities. You can buy treasuries in our parlance on 100% leverage. You have for 200 years. That's the way this market works. So September 4th, when yields were falling, there was a tremendous demand to buy treasury securities. Rates were going negative in Europe. So buy. What's the next thing after you're done writing the ticket? Call the repo desk and finance it. And we were seeing more and more and more demand for repo until we finally realized, and then we had the quarterly tax payments and some other things, the market broke. We can't handle it. There's too much. People are asking for too much of this. And then when they couldn't get their repo, you saw the market go the other way. So yeah, it can matter to these things as far as the level of rates and maybe even the stock market as well too. For now, let me emphasize again, for now, the Fed has medicated this market. It is allowing it to function. That's fine for the next several months, but it's not a permanent fix. We cannot just say, well, the Fed will permanently supply repo forever. That will give a whole host of problems down the road. It's a private transaction market. You don't want somebody like a central bank taking over that market and running it. It's not a good long-term solution.
Are the people connecting it to the stock market rally, though, being unreasonable?
I think to some extent it's a situation. It's like your plumbing, right? When it works, you don't have to think about it. When it's leaking, you think about it. Well, when it's working, it's not causing a stock market rally, but when it breaks, it can cause a stock market problem. I think it's more, in the words, asymmetric. Okay. It's not going to cause you to go up, but it can cause you to go down if you get a problem with it.
All right. Well said, Jim Bianco.